You were told gold should shine when the world gets dangerous, so why does it sometimes fall right when fear explodes? That contradiction is where most investors get emotionally trapped. The headline says panic, the market says something colder, faster, and much more mechanical. In this video, I'll show you the hidden sequence that can push metals down first, why that doesn't automatically break the bull case, and the two signals that matter more than the noise. This is what makes the move so frustrating. People aren't usually reckless here. They're following the respectable playbook, and the respectable playbook suddenly feels like it's stopped respecting reality. The easy story says crisis begins, gold rises, end of lesson. Real markets are rarely that polite. They price the shock, the policy response, and the funding stress almost at the same time.
One reason viewers get whiplash is that markets run on different clocks. News moves instantly. Policy expectations reprice fast. But positioning, funding stress, and margin pressure can hit before the deeper narrative settles. In the opening stage of a shock, investors often don't ask what they love most. They ask what gives them immediate flexibility. That small difference can push cash and short-term yields ahead of metals for a while. Gold can be a store of confidence without behaving like a same-day panic button. Silver is even trickier because it sits between monetary fear and industrial reality. That makes the early move look confusing, sometimes even unfair. The key question isn't just whether conflict looks scary on television. The deeper question is whether it changes energy prices enough to reshape inflation, rates, and currencies. That's where the metal story usually gets rewritten. So let's rebuild the chain from the ground up. Not the dramatic version, not the marketing version, but the version that explains why metals can look wrong before they start making more sense.
When oil jumps, it rarely stays in the oil market. It leaks into transport, production, food, shipping, and business expectations. That's why energy shocks feel bigger than one commodity chart on a financial screen. What matters next is not only current inflation, it's what people start expecting. Once businesses think costs will stay hot, they pass more through. Once consumers expect higher prices, psychology starts reinforcing the move. That's when central banks enter the story. Even if they didn't cause the shock, they worry about losing control of expectations. The market then starts pricing a tougher stance, sometimes before any meeting actually happens. That repricing hits bonds fast. Prices fall, yields rise, and suddenly the market is offering better compensation for holding paper that actually pays you something. For non-yielding metals, that changes the competitive landscape immediately. Higher yields can also pull money toward the dollar. If the US offers tighter policy, deeper liquidity, and crisis-era demand for safe funding, the currency can strengthen even while fear is rising elsewhere.
Gold doesn't throw off cash flow. So when real or expected yields rise, the opportunity cost of holding it becomes more visible. That doesn't kill the thesis forever, but it can absolutely pressure the price now. Then comes the part many retail investors mistake for a verdict: forced selling. Funds don't always sell what they hate. They often sell what they can, what's liquid, or what helps them patch another hole. Now you can see the trap. The first move in metals may reflect rate shock, dollar strength, and liquidity stress more than the final consequences of the crisis itself. Price moves first. Interpretation often catches up later. Notice what this is not. It's not a magic trick, and it doesn't require a cartoon villain. A lot of apparently bizarre price action becomes easier to understand once you follow the pipes instead of the headlines. The surface story says fear should help precious metals instantly. The balance sheet story asks who needs cash, where yields are going, how the dollar is behaving, and whether policy is getting tighter before it gets trapped. Silver often gets hit harder in the early phase because it carries more than one story. It's part precious metal, part industrial input, and that makes investors debate growth risk at the exact wrong time. If investors fear slower manufacturing or weaker industrial activity, silver can absorb a double hit. It faces the same yield and dollar pressure as gold, plus concerns about future demand from the real economy. This middle zone is the uncomfortable part. The shock has happened, but the longer-term consequences haven't fully taken control of markets yet. That gap is where metals can disappoint the people who expected instant validation.
The turn usually begins when markets stop asking whether rates can rise and start asking how far they can rise before something important breaks. That is a very different question, and metals respond to it differently. Once the market senses that tightening has limits, metals stop trading like victims of the shock and start trading like eventual beneficiaries of the policy bind. The narrative changes before the headlines admit it has changed.
The stronger leg higher usually needs a second ingredient. Either growth starts bending, policy expectations soften, or confidence in endless rate pressure fades. Without that shift, metals can stay choppy longer than people think. That's why bottoms rarely look heroic in real time. They look messy, hesitant, and emotionally unsatisfying. If the move were obvious from the start, it wouldn't shake out nearly enough people to create the setup. Most people don't quit at the bottom because they're irrational. They quit because confusion is exhausting. After enough false starts, the need for emotional relief becomes stronger than the need to stay logically consistent. Take the 1973 oil shock. In hindsight, people remember the metals boom. In real time, the path was not a clean, straight staircase. The economy had to absorb the inflation wave before the bigger repricing fully arrived. What mattered wasn't just fear. It was the way energy costs rippled through the system, changed inflation behavior, and forced markets to reassess policy. The metal story became powerful because the macro story became difficult.
That historical lesson is important because people usually remember the destination and forget the turbulence. Metals can be right about the bigger problem while still trading badly during the market's first attempt to understand it. Eventually, the inflationary consequences overpowered the earlier confusion. That's the key distinction. The first move was about adjustment. The bigger move was about recognition that the problem was larger and harder to contain. So the lesson isn't that gold always jumps the second danger appears. The lesson is that energy-driven inflation can create a delayed but powerful setup once markets realize the policy response has its own costs. The late 1970s episode pushed the logic further. By then, inflation psychology, energy stress, and monetary distrust were feeding each other. Metals didn't just respond to events. They responded to fading confidence in the system's answers. That does not mean investors should romanticize the blow-off stage. Late-cycle parabolic moves can be spectacular and dangerous at the same time. The point is to understand the setup, not fantasize about catching the most traumatic frame.
After 9/11, gold reacted to the immediate shock, but the longer story came from a broader shift in macro conditions. In other words, the event opened the door, but the sustained move needed larger monetary and economic forces. The 2022 Russia-Ukraine period is especially useful because it felt so intuitive at first. Gold jumped on invasion fears. Then a stronger dollar and aggressive rate pricing pushed the metal back under pressure. Across very different eras, the same broad lesson keeps appearing. The first response can be noisy and even misleading. The larger move depends on how inflation, policy, and currency pressures evolve after the initial shock. Now comes the most important twist. Today is not the 1970s repeated. It may be more constrained. The system is carrying a far heavier debt load, which changes how far policymakers can lean on high rates. The United States is now operating with roughly $39 trillion of federal debt. At that size, higher rates don't just cool speculation, they also magnify the government's own financing burden much faster.
According to the Congressional Budget Office, net interest outlays are expected to exceed $1 trillion in 2026. That matters because every rate decision now echoes through a budget already strained by scale. In earlier decades, policymakers still faced trade-offs, but the present structure makes those trade-offs heavier. When the debt base is enormous, even modestly high rates can become expensive in a hurry. That creates a genuine bind. Stay too easy, and inflation pressure can linger. Stay too tight for too long, and debt service strain grows larger. Markets eventually notice when both roads start looking costly. When I say there's a ceiling, I don't mean rates can't rise. I mean the runway may be shorter than the market initially assumes. That distinction is exactly where the next metals debate lives. Markets often price the direction first and the limits later, so metals can suffer early from higher yield expectations even if the final destination for policy turns out to be much less aggressive than feared. The turning point begins when traders stop reacting to each inflation scare in isolation and begin asking whether the system can tolerate extended restraint. That shift in framing can be subtle, but it's powerful. As confidence in endless tightening weakens, metals usually get room to breathe. Not because all fear disappears, but because the opportunity cost argument loses some of its force when the ceiling starts to matter. That's why weakness in metals during the crisis does not automatically disprove the longer thesis. Sometimes it simply reflects the market's first reaction to policy pressure before the larger fiscal and monetary tension takes center stage. Gold and silver often travel together, but they are not the same story. Gold leans more directly into reserves, policy, and confidence. Silver has that layer too, but it also answers to real-world industrial use. That broader industrial footprint is why silver can look unusually interesting in an electrification cycle. It is tied to more than investor mood. It is also tied to how modern systems are being physically built.
The Silver Institute notes that battery electric vehicles use materially more silver than traditional internal combustion vehicles, with roughly 25 to 50 grams per EV and a significantly higher loading than older designs. Solar matters too. The same source shows photovoltaic demand taking a much larger share of silver industrial use over the past decade. That means the silver story is increasingly tied to long-duration infrastructure decisions. Then there's the AI and data center layer. More computing demand means more electrical systems, more hardware, more infrastructure, and potentially more silver intensity across the stack, even if precise loadings vary by application. The supply side isn't a simple fairy tale either. The silver market has still been running with deficits, while industrial demand has remained strong. That does not guarantee a price spike, but it does tighten the backdrop. That mixed identity is exactly why silver can be explosive. It can outperform dramatically when monetary and industrial forces line up, but when those stories diverge, silver can feel far more erratic than gold.
That volatility attracts the wrong kind of attention. People love silver when it looks exciting, then hate it when it behaves like silver. If you're studying it, you have to respect both the upside and the temperament. So think of gold as more directly connected to reserves, policy credibility, and currency confidence. Think of silver as a hybrid, part monetary metal, part working material inside the modern economy. That hybrid nature changes the timing. If someone uses the same emotional framework for both metals, they often misread both. Gold asks for patience with macro policy. Silver asks for patience with macro policy and the real economy at once. This is why institutional views can sound contradictory without actually being contradictory. A desk can be bullish on the longer path for metals and still expect short-term pressure if yields, the dollar, or positioning turn against them first. For example, JP Morgan Global Research has discussed a much higher gold path into late 2026 and 2027, while also acknowledging periods where the metal can feel stuck, technical, and temporarily out of favor.
Other banks have also published high-end scenarios, including examples reported by Reuters around the low 6,000s. That doesn't mean those numbers will happen. It means serious institutions see a path large enough to model. The difference between a forecast and a tradable path is huge. A destination can be compelling, while the route remains emotionally brutal. That's why so many people agree with a thesis and still fail to stay with it. Path matters because psychology lives inside the middle, not the final chart. Most people are not defeated by being wrong on the big picture. They're defeated by underestimating how uncomfortable the middle can become. So yes, metals can dip, even when the longer case remains intact. If the dollar is climbing and yields are pushing higher, that near-term pressure can dominate the tape before the structural argument reasserts itself. Another quiet support comes from reserve diversification. The World Gold Council estimated strong central bank buying in the first quarter of 2026. That doesn't cancel volatility, but it helps explain why the long-term floor may be firmer.
That distinction matters. Strategic demand can reinforce the backdrop without saving investors from every drawdown. A strong foundation is not the same thing as a smooth ride, and confusing those two leads to bad emotional decisions. Now let's be fair to the other side.
If growth stays resilient, inflation stays sticky, and policymakers keep enough credibility to remain firm, metals can absolutely stay under pressure longer than bulls expect. In that environment, gold's lack of yield becomes a real handicap again. If investors are getting paid handsomely in cash-like instruments and real rates remain elevated, the urgency to own metal can cool off. A persistently strong dollar can also extend the pain. Since precious metals are globally priced through that currency channel, dollar strength can act like a headwind even when the broader fear narrative still sounds supportive. Silver has an extra vulnerability here. If the economy weakens before policy clearly pivots, industrial demand fears can keep silver sluggish, even in a world where gold starts looking a little more resilient.
Supply can adapt too. Recycling rises when prices improve, mines respond on different timelines, and substitution can appear in some uses. So even a structurally supportive story still has friction, maintenance, and offsetting forces. This is why geopolitics by itself is not enough. The event matters most when it changes inflation, policy expectations, liquidity conditions, or reserve behavior. Without that transmission, fear can stay loud while metals stay unimpressed. What we're doing here is not fortune-telling. We're weighing probabilities. The most useful market framework is rarely the loudest one. It's the one that leaves room for path dependence, timing risk, and imperfect information. Humility is not weakness in markets, it's protection against seductive narratives. The goal is not to sound prophetic. The goal is to understand what would confirm the thesis, what would delay it, and how to stay emotionally functional. Major bottoms rarely begin with confidence, they begin with confusion. The thesis starts sounding better, yet the price still refuses to cooperate. That mismatch is usually the first test of whether someone understands process or only headlines.
Then comes irritation. People stop asking what the market is discounting and start demanding validation. This is where narratives become personal, and personal narratives are usually terrible tools for reading a macro transition. After frustration often comes boredom. That stage matters more than most people realize. Markets use time as a filter. They don't just shake out weak hands with price, they wear them down with repetition and delay. Then a bounce appears, not a movie scene breakout, just enough strength to make people wonder whether the regime is changing. Ironically, by then, many viewers are too mentally tired to trust the move. That's why the next hesitation can be so important. If the market absorbs bad news better, holds support better, or reacts less dramatically to rate scares, the character may be changing before the trend looks obvious. By the time the signal feels emotionally comfortable, much of the easy psychological opportunity is already gone. That doesn't mean investors need to be early heroes. It means perfect clarity usually charges a premium.
If you want a cleaner framework, stop asking whether the news sounds dramatic enough. Ask whether yields are still rising and whether the dollar is still strengthening. Those two variables often tell you more than the theater. First, watch the yield story. Metals usually struggle when the market is aggressively repricing higher returns from safe paper. When that repricing slows, stalls, or starts reversing, the pressure on non-yielding assets can change fast. Second, watch the dollar. A relentless dollar surge can suffocate metals longer than people expect. But when that strength stops broadening, the market begins removing one of the heaviest short-term weights from the trade. When both signals begin easing at the same time, the setup becomes much more interesting. Not guaranteed, not effortless, just more coherent. That's the moment when the market may be shifting from forced logic to structural logic. So the real lesson is not that gold and silver failed, it's that markets move through sequences, not slogans. If you follow the chain instead of the panic, you give yourself a better chance to think clearly when others can't.